All right, guys, let's get going. It's 11 o'clock. People that come in late, come in late. I'm going to record this. But, Peter, before I introduce you, let me just spend like 2 or 3 minutes to kind of go. But I made this part of our weekly session that I have, and I invited some other people to come to just this Tuesday. But every Tuesday at 11, core group of edge traders meet every week at this time, and we go over content. At the beginning of it, I just go really quickly through what's driving the market in case they're also not in the trading room and things like that. So let me do that. Then I'll introduce you. Then you could take it over and run with it. Sound good?
Sounds good. Yep.
So many of you know, many of you don't. You have to kind of understand that today, even though we just rallied finally, was quiet. They're waiting for the FOMC today, tomorrow with 1 o'clock. The surprise, if you're not around the trading room, I'll go over this in detail tomorrow in the trading room. If you're not around for that, tomorrow at 1 when they come out, the surprise would be if they're not as dovish as the market is baked in. And so Powell a couple weeks ago set this market up to rally by being dovish. If for any reason the statement's hawkish tomorrow, it'll be bearish for stocks and bonds. Now, that shouldn't happen, but that's why they call it a surprise, right? Make sure you guys know that going into tomorrow's statement. Brexit, it's like a mess, but the market doesn't seem to care. I think eventually the path of least resistance is to kick the can and extend the March 29th deadline, and the market's rallying. Watch the pound if you want to get an indication on how sensitive different Brexit headlines are from moment to moment. U.S.-China trade, they've already kicked that to maybe an April meeting. If President Xi and Trump meet, they'll have a deal. There's optimism, pessimism. It goes back and forth. But you look at the market, we're making relative newer highs every time you turn around and look. So they're pricing in a deal. No deal, and the surprise of maybe more tariffs and a trade war would create bearishness, and that would be the outlier at this point. But remember, if you're in front of your screens and you get a black and white comment that he's going to come and meet and they're going to have a deal signed, you have to know what to do. If you're in front of your screens and they come and say we're going to tariff the hell out of them because they won't cooperate, you need to know what to do. Bullish, bearish. That's what's driving this market. And it comes and goes. Gets quiet. Nobody's talking. And then all of a sudden it's the main driver. I really think, though, it could be a sell the news type of an event tomorrow at 1. I do think a lot of this bullishness is because of a dovish Fed that's going to keep interest rates low. And then the last thing is it seems to shake off anything negative. The Boeing tragedy, the Brexit is more pessimistic than optimistic. It just seems like anything negative, the market just eventually rolls right through it. So that's it. Generally, for guys that aren't in this Tuesday session, we go into some slides and presentation, and I create and push out my own content. And it's almost like what we created here, Peter, was if you worked in a prop firm, you would at least meet with the fellas once a week. Maybe even more than that, but at least once a week. And that's what my Edge program, what I created was I couldn't give guys education and say, here's the start, here's the finish, good luck, goodbye, and you'll do great. In order to really give guys the best chance to get and stay successful, they got to keep coming around and meet. And it's good for me, it's good for them, and it's like it's that monthly or weekly conference room meeting you would have with your employees or your employers or your colleagues, coworkers to talk markets and be structured about it. When I was in a prop firm, they made guys, I think the third or fourth class after I was hired, we weren't made to have to go into structured education. But after a couple of years where they hired these other guys, they made them go to class after each session. And so that's what these weekly events are. And once in a while, I have guest hosts that are really good. But this week we got Peter instead. I'm just joking, Peter. You guys know that Peter's, I said this before, and I don't want to talk too nice about Peter because you guys will think we're dating. I think I was too nice to you last time. But I've known him since 2011. You guys know him from Jigsaw. Software is great. He's a better person than he is a software developer, and his software is great. So he's one of the normal guys in this business, and everybody I've ever talked to that's had a personal experience with Peter talks about how nice of a guy he is. So that, aside from he eats turtles and rats, he's a pretty good guy. The people are going to listen to this and say, what the hell is he talking about? We were talking about Thai food before we came on live. So, Peter, you want to take the screen and just take over?
Will do, yeah. Just give me 1 second.
Take your time.
Okay. All right, so you should now see my screen set up. I did change the introduction a little bit for you. That's the fried duck beak. That was one of the dishes with my...
Wait, leave that on. That looks good. So yeah. It's crunchy then, right? Or what do you eat?
You kind of eat the skin and the gristle and all that around it. So it's, it's kind of chewy. It's a chewy experience.
Well, so in the middle of it is the meat.
I think that's the tongue. Well, I just tend not to ask. Tend not to ask, you know.
Oh man! So you don't actually eat the bone or the actual chunky part, or do you?
No, I don't think so. Well, I never have, and I've never seen anyone. But I've seen stranger things.
Oh, that's cool. All right. Well, that's the 8th setup for Jigsaw traders. Duck beak. That's cool.
Cool. Okay. Right. So what we're going to do today is we're going to look at a number of setups. And of course, there's always a twist with the webinars we do, because we're not going to just say, here's a setup like a moving average crossover, and then, that would be kind of ludicrous. So we're going to look at the setups, but we're going to look at them from a particular perspective. We're going to break down each setup into components or building blocks. And among those building blocks are, when each setup works, which market conditions, why they work. And why they work, I mean, why would buyers and sellers engage after you get in and move markets your way? Another building block is what confirms that the trade is setting up. Another, how to confirm the trade is going your way. And then finally, what you should see if the trade is failing. Now, I chose these specific setups to look at as they all have slightly different answers or different building blocks. Yeah, as you see, as we go through, there's a lot of commonality between them. So at the end of the session, what I hope you can do is to be able to go back to your own setups and look at them in a new light, and look at them in light of these building blocks, make them work better for you, maybe throw 1 or 2 of them away, maybe replace them with some of the setups you see today. Anyway, what makes a good setup? Well, first of all, the ability to replicate it consistently is obviously a good thing. The ability to spot it in time is another. Frequency, I think, is very important. The more often something happens, the sooner you're going to become proficient at it. Most setups work well in specific market conditions. Okay, and we'll see that today. So anyone that saw the volatility increase in October of 2018 and decrease again in 2019, January, you'll probably have seen something stop working at both of those points. And we'll take that into account today. The other thing, knowing who's on the other side of your trade, also important, as is knowing who is likely to be joining in if it works out. And not just knowing who, but also knowing how they're likely to trade and what sort of move their participation should generate. And in turns, this means having a way specific to each setup of knowing if it's working or not. Now, setups that are close to some kind of tipping point or a decision-making point for the market are generally better, as they have less risk. And with the firms I work with, most of the professional traders generally look for a skewed risk-reward ratio and not really that much concern about win rate. So it's not unusual for some of the best traders in the firms I know to have win rates around 50%, but with the winners 3 to 5 times the losers. And in fact, that's so important, it's actually worth its own slide. Now, I'm going to say there is an exception, because I do know scalpers, market-making type scalpers with much higher win rates than 50%, a lot close to 85%. But those higher win rates are usually associated with much, much lower time in trade. So I know one guy who can be in and out of trades in 7 seconds. He's in and he's either out again at the price he got in, or he's flipping it on the other side. That means trading for small moves, having to overcome the impact of commissions with trades that have a very small target. So if you hear of a scalper or a market maker with a very high win rate, it's not really because that approach is better. It's just that certain short-term techniques do produce higher win rates, and they actually need to. Anyway, let's have a think about 2 systems. We've got one with a 1 to 4 risk-reward ratio. So for every one tick we risk, we're looking to make 4 ticks. The other has us risking 8 ticks to make 4. So we both are looking for 4 ticks, both are profitable. All good, right? And they're all good until you have a bad run. So with this first one here, you don't start to lose money until your win rate dips below 20%, or probably more like 25% with commissions. The other system now, much less forgiving. Anything below 66% win rate and the losses start to rack up. And I know one trader doing an extreme version of this right now. He trades ultra bonds with 10 lots and he gets out one tick, which on the surface is good. It's $32 and change a tick. And you can see day in, day out, he's making money. He's banking $325 from his one tick trade and stopping for the day. So day in, day out, it's like 300 after commissions, 300 every day. Every now and again, he loses 5K. And now he's in catch-up mode. Now, at the point where he has one of those big losers, because he's so skewed on the risk side, how do you think the guy feels about the next trade also booking a $5,000 loss? And I can tell you, he's scared, right? So whilst a lot of traders are looking for this holy grail system with a high win rate, the goal really should be high risk reward and forget about the win rate, because the worst situation you want to be in is, as a trader, is to have a drawdown and need to maintain a high win rate in order to claw it back, right? This isn't a mathematical thing, right? This is a in your head thing, right? You get, if you're used to like an 80% win rate and you need 66%, you get 3 consecutive winners, you're now scared money, right? If you can live with 4 losers out of 5 and still break even, you're never going to be worried about the next trade being a loser. Anyway, onto the first setup. And what you can see here, this isn't a chart. It's more like an egg with a stick through it. So the first thing I want to do today is just forget about the market as something that moves from left to right, and think of it as something that moves up and down. A market where at any point, some people are long, some people are short, where things like time frames are really not that important. So whether you're looking at a 1 minute, a 3 minute, a 60 minute, whatever, doesn't really make a lot of difference in terms of what's going to happen next. So what you've got at any one time is just traders that are positioned and traders looking to add, to create new positions or increase their positions, and really nothing more than that. So on this diagram, what we've got is a line here through this little egg that shows us where we've traded on that day. And then the egg itself just represents an area of high volume. In other words, we're in a trading range at the moment, an area we've been trading for a while. There's no evidence of this range breaking yet. And we've all seen ranges before. I know you all watch Anthony. I know he likes trading ranges and the breaks and that. Now, this could be an all-day range, or it could be one of those like 10, 15-minute micro ranges that forms as the market takes a breather in an overall trend. For this range, this setup, it doesn't really matter. All that matters is the market has been in a range for a while, volume is built there, and it's observable, right? So this isn't a range trade, it's a pullback. So next thing we're going to see is this. What we see is the range breaks the upside. We're no longer in the range anymore, and we're starting to pull back. And the market pulls back to the top of the old range. And what do we see? Continues up from there. Now, that's the basic setup. Obviously, there's a lot more to trading this setup than just that. So let's consider the building blocks of things that we want to know about each trade. Okay, so when is it that this trade actually entering long at the top of the old range, when does that work? Well, in a trending market, we tend to take a breather, build some volume, and then break in the direction of the trend. So it's often, if you watch any market trend, you'll see it build, and then you'll see a couple of prices where a lot of volume trades, and it'll tend to just start crisscrossing over that 1 or 2 prices with a lot of volume. And that's just like a breather in a range. And then eventually it'll break out. This trade also works in an overall dead market that's finally broken. Now, why does it work, right? Well, you've got longs and shorts positioned where this volume is, right? So when you break to the upside, the shorts get stopped out, right? As we come back, just means that overall, sellers are less likely to engage to the short side in the same location. They've just lost money, right? So you've got a whole bunch of longs and shorts in here. Market breaks the upside, the longs make money, the shorts lose money. You come back to that old range high, and it's just like a little bit of an imbalance where sellers just a little bit less We're a little bit more wary about getting into the market the same direction. In a trending market, if we break in the direction of the trend, it's much easier for traders to engage in the direction of the trend. Again, it's like the path of least resistance in the market. Now, what confirmations are there? Right. So anybody want to guess what would we want to see before we got into this trade? Something we might want to see before we engage. Anybody want to guess? I shall give you a second to type. Unless you're all shy, of course.
Hey, while they're typing, do you? I really like these images because they give you a sense of a candle, but they're not.
Yeah,
it's a good way to explain it. I think a couple people popped in.
Yeah. Somebody's saying buying to pick up some temporary increase in negative delta, followed by a taper off that. Yeah, increased volume on initial breakout. There you go, Ed. Increasing delta as well. What I'd want to see first, right, is increased volume on initial breakout. Of course, if this trade's going to work, right, you need to see a stop run. If this trade is relying on sellers not engaging again when we get back to the top of their old range, you actually need to see the sellers get stopped out. So if you have a lot of volume on this push up, a lot of volume, a lot of pace, real frenetic trading, like people have got stopped out, that means it's truly broken to the upside. There should be people stopping out, and that means you're going to get a pop. When you leave this area, you're going to get a pop. You're going to get a fast move, an explosive move. That's the stop run. Now, there's going to be other times when you see exactly the same thing, but this move out of the top of the range is just dull and slow and not really got much pace to it. And in that case, there's no stop run. It could quite easily mean the people in this range here are quite happy that the range is extended to the upside. Okay? And if that's the case, if you don't see that kind of explosive move at the top of the range, premise for this trade is not there at all. Now, if this trade is not working, generally speaking, the first sign of this trade not working is it'll start to grind down back into the top of the old range, right? No follow through to the upside. If the trade is working, what you're going to see is as the market moves up, you're going to see a nice pickup in pace, a little bit slowly at first, but as you start to move up and people start to see, different people see, kind of realize at different times, but as different people see that the path of resistance is now obviously to the upside, then you're going to see a nice, regular, decent pace move to the upside. Not as fast as the explosive move here, but basically a nice move up. Now, risk and reward. Well, your risk on this trade, depending on how quickly you spot it, obviously, is a few ticks. It depends on the market, depends on the volatility. Obviously, we have to adjust. But basically, your risk is a few ticks into the range. Your reward, basically, is somewhere above this high, okay? And for me, I like to scale out of trades. I don't like to pick where the market will go to. But basically, the sky's the limit. So this is a trade, basically, good risk-reward ratio, good upside potential, pretty clear where your risk is, pretty clear where your entry point is, because it's basically just the top of the old range, and where you don't have to be right all the time, okay? The only one downside to this trade in reality is timing it, especially if you're trying to get it right at the top of the old range. On the S&P, quite a lot of times on the S&P, it'll come down one tick above the old range and then move up. And of course, if you put your limit order one tick above the old range, it'll come down, touch your price, not give you a fill and disappear without you. So the only downside to that trade is kind of timing it if you get a little bit too greedy and needing it to really come down and hit the old range. Okay, turn here can be a little bit fast sometimes, and without a lot of warning, without a lot of confirmation, apart from the fact that you already knew in advance where people had stopped out. Okay, so that's the kind of things that we're going to look at in terms of things to ask yourself, the building blocks to look at during a trade, when it works, why it works, pre-trade confirmations, and post-trade assessment. Now, what we're going to do, go to another pullback trade. Okay. Now you might say, well, wait a second. Aren't all pullbacks the same? We can't keep looking at pullbacks. And of course, all pullbacks have things in common, but there's also very specific entry triggers that play out differently. And that's going to become clear as we move on. So here's stage one, market that is moving upwards. Okay. Then you see a move down. and it ends in a large amount of trading at one or more prices. One price on thicker markets like bonds and quite often S&P, currency futures. There's going to be a few prices on crude, NASDAQ, Dow, DAX, the thinner markets. And this will often be one-sided trading, right? So quite often it will come down and there'll be a lot of selling absorbed by the bidders. Might be two-sided. It's better if it's one-sided. It's better if it's more sellers getting trapped. It gives you a bigger pop, but it's quite often two-sided as well. And what we're seeing effectively is an iceberg order where people are trading, the selling continues, people keep selling in to here, and the bidders are basically trying to hide their size. So typically you'll see something like 2,000 contracts trade against 500 bids, and at the end there's still 500 bids there. So the bids never went above 500, but 2,000 traded, okay? And that's the layup. So when would you take a trade like this? Well, first of all, obviously, in a trending market. When it doesn't work so well, even with a directional market, is if it's a news-driven day or a really heavy one-way market. They tend to be a bit more erratic. So there are some kind of trends where it's just juggernaut and just going mental, in which case the pullbacks tend to be quite volatile themselves and tend to be a little bit hard to time. And you might see a price where 3,000 trades on the bids and it just goes straight through it. This is more for like a regular trending day where there's not really a ton of news coming in, but the market's just swinging up and down nicely. Now, why does this work? Well, basically what we've got here on the way down, counter trend sellers get stuck in this area here. They can see it. Everybody else can see it. Everybody else knows that overall the market's been going up, and sellers see the market no longer moving down, as a result of their selling. And so they start to bail out of the trade by buying. Now, time's a factor in this too. As this volume here takes time to build, and the more time it takes to build, the more people that can actually see this and either realize they're stuck or realize that other people got stuck. And as we lift away, traders realize that the path of least resistance again is to the upside, and that this obviously is not a reversal. Okay, next thing, what confirmations are there, right? Well, what we want to see, the first confirmation is the iceberg, right? We want to see lots of volume at one or two prices. We don't want to see the market, you don't want to see thousands and thousands of orders come in and then for 50 to trade, right? That's what we want to see. We want to see, really want to see an average kind of move. So even on this move down, we really want the volume in this swing down here to be kind of average, not to be a massive swing down. If you've got a lot of volume pushing down on a counter trend move, even if you do see a little iceberg there, so you want to be a little, just a little bit wary of it and not just kind of hit just because there's an iceberg. There is this tendency, since people learned about iceberg orders, to want to jump on every one of them, right? So you want to see like a normal pullback with this kind of pace you've seen on previous pullbacks that day, and then just see that big volume at a couple of prices. Now, if this isn't working, what are we going to see? Well, any move below the iceberg means we're in peril. And this makes it one of the best trades, obviously, from a risk-reward perspective. And then the other sign of failure is if it does move up, it fails to get through the high, right? If you can't get through the high and it just dies out, again, you need to bail on the trade. Any sign of manipulation as well, any sign of manipulation also is something that we might see, might show that this is failing. So basically, if we come down here to hit the iceberg, go through the top 4 or 5 ticks, and then you see another iceberg on the other side, that's probably a manipulation move, right? Now, what we expect to see if it is working, well, as you move away from this iceberg, you should see a little pop. It's not going to be the same kind of stop run as when you move out of a range you've been in for 30 minutes, but there's going to be a little pop as the 2,000 or 3,000 traders here, half of them get stopped out, move to the upside. And then we expect to see people joining in as we move up, large size, mostly on the buy side, traders jumping in, decent pace, starting to pick up, but not the kind of pace you see in the stop run. So you start to see people join in, and then fairly clean acceleration through the high. Okay, next, another pullback, different layup though. This is a fade, right? A fade occurs when you run out of interest. So a fade is the opposite of an iceberg. So in an iceberg, you get lots of positions at one or two prices. With a fade, it's a lot more difficult to see. And that's what makes it, in my opinion, a better trade. Okay, so think about it. When we had the iceberg trade, we actually moved down and we built a lot of volume at one price, and that took time. During that time, lots of people can see it and react to it. And more importantly, there are big players in the markets that can nudge things around. So kind of basic manipulation tactics. So when you see thousands of contracts at a couple of prices, there's actually a bigger payoff for a shark in the market to nudge people out of a position. So there's a lot more interest there. So the fade is the opposite of that. What the fade is we move down and the volume disappears, dries up. There's hardly any contracts trade at the prices. And when that happens, there's no point nudging the market around. So if we move down and we trade 50 at a price and go down to the next price and trade 30 and go down to the next price and trade 20, there's nobody really going to nudge those people around. There's nobody to stop out, right? So with this trade, it's a little less obvious. It's just a fade, running out of counter trend sellers, less chance of manipulation. So the market basically moves down and we see a slowdown. We often hit a price where, like a handful of contracts trade, we'll tick back up, come back down to that price again. Again, don't see anything trade. You could see like 12 contracts trade. No interest to the downside. And what you see is you eventually see the first trade, just start to see some people coming into the upside. And again, it's not long before the path of least resistance is established again. So again, when does this work? Well, it's regular trend days, not massive news-driven trend days. Why it works? Well, the simple fact is, if there's no one willing to sell, the markets can't actually carry on down, right? You need sellers to push the market down. So sure, we could just run out of steam altogether and start moving sideways. But generally speaking, what you see is you'll start to see buyers tentatively come in and start throwing some contracts at the market, seeing what interest there is. But that whole process takes a little bit of time. So not everybody jumps in at once. So what confirmations do we have? Right? So it's what you don't see that confirms this trade. You don't see big sellers. You don't see a lot of downside momentum. You don't see large volume. You see less and less as you move down. So what do we expect to see if this trade isn't working? Well, quite simply, if you see a flood of sellers come into the market, then get out because you're wrong, basically. And that does quite often happen where there'll be nothing there and then somebody comes in and whacks it down a few prices. If it is working, what's going to happen is because people are a bit more tentative in this situation and the buyers start to throw a few contracts in, there's no obvious line in the sand. You'll start to see the pace of trade to the upside kind of just gradually increases. There's not much pop initially. You're much more likely to start to see acceleration as you get to the old high than on the way up. And basically normal flow of trade resumes. Now, it seems that this is a poorer trade because it's a lot more vague. It's a little bit harder to spot. But I like this trade. This is one of my favorite trades. And of course, the other markets that we'll see correlated market trades in a minute. I actually like this better than the iceberg, purely because of the lack of size trade. It tends to, when it moves up, it tends to move up a lot cleaner. Okay, different trade. And it's the last of the pullbacks, right? Now, actually, this trade could be used in conjunction with the prior pullback setups, but often this is your cue to enter on correlated markets. So what we've got here, we don't have one market, we've got three markets. Could be the Dow, NASDAQ, S&P, could be interest rates, could be any three correlated markets. So the first thing to know about correlated markets is that those correlations tend to break down. In fact, with the Dow, NASDAQ, and S&P, you can actually use that breakdown in correlation to determine if the markets are trending or reverting to chop. So presumption here is that all three markets are generally moving together. In this case here, we can see they're all pulling back, but all to different degrees depending on liquidity. And then what we'll see, one of the markets or two of the markets will pop to the upside. So if you look at Dow, NASDAQ, S&P, it's often the Dow or NASDAQ that will appear to move first. But this is an optical illusion. So one of the things we've got to understand, really understand liquidity here, because the S&P is thicker, it takes longer for buying to become evident in terms of a price move, right? So think about it. If buyers come into all three markets, Dow, NASDAQ, S&P at the same time, you're going to see Dow and NASDAQ showing price progression before the S&P. That's even if buyers hit all of them at the same time. Another way to put this, a 1 tick move on the S&P is like a 4 or 5 tick move on NASDAQ, right? So a 2 tick move on the S&P is generally going to be met with an 8 or 10 tick move on the NASDAQ as well. So it actually appears that the NASDAQ is getting the buyers coming in first, but it's just that you can see an 8 to 10 tick move a lot easier than you can see a 1 or 2 tick move, right? So back to our 4 questions. When does this work? Okay. Well, it's a trending market play simply because path of least resistance is to the upside, right? Why it works, right? Well, there's never a clear and consistent leader when looking at correlated market, but arbitrage does keep the markets together. You just have to know when that correlation is on or off. So it's effectively arbitrage trading that's going to pull your market along with the others if one breaks first. So what confirmations are we going to see? Well, really, the only confirmation you get is the jump or like a spike in one of your markets or 2 of your markets. Now, what do we expect to see if this isn't working? Well, what happens is those markets that initially tick up, they start to fail and start to tick down again. And the beauty of this trade, right, is if that happens, right, if you're watching the Dow and the NASDAQ, the Dow and the NASDAQ, yeah, and the Dow and the NASDAQ start to spike up and you think they're continuing, you get in on the S&P. Quite often what will happen, the Dow and the NASDAQ will spike down again. And you might want to say, well, I'm going to back off the trade. And you're going to be backing off that trade quite often before you've lost any money, right? You're not going to be seeing the S&P spike down because we've already said the S&P generally has smaller moves relative to the others. So you can quite often unwind your position for a few ticks profit or a very small loss when this fails. Now, it does help, of course, if you're trading the least volatile of those correlated markets, right? So you don't need your market to move against you to see that this trade is over. Now, what do we expect to see if this is working? Well, you can actually use this correlation, obviously, combined with the other 2 pullbacks. But in addition, if you just see one market move up, your first confirmation is that the others start to join. And as they all start moving up, you should start to see the pace of the market start to increase, right? So once they all start to move in the same direction, it's not that kind of very fast, explosive move that you get with a stop run. So you don't expect a massive pop, but do expect all 3 markets to put in a nice little run up. Now, the key to this one is practice and pattern recognition. So this is one of the best trades out there, in my opinion, but there is no way you'll get it right on day one. And I've shown people this, and the tendency has always been to go and try and trade it and get disillusioned with it. So you need to experience watching these correlations a number of times, experience working trades and failed trades. And the more you watch it, the more confidence you're going to get in sorting out the winners from the losers, okay? And the beauty of that is you're already sitting there anyway, right? So if you're not watching, if you're trading the S&P and you're not watching the Dow and the NASDAQ, it's like a 0 cost for you to do that. But if you're trading the S&P and you bring up the Dow and NASDAQ tomorrow and you start trying to use them to trade the S&P, I guarantee you'll fail because you just won't have built any experience in that. Okay, here's one as well. So this is the kind of thing you're going to see when these markets pop first. Okay, so you can see what generally happens is you've got a market moving down there. You get a pullback. You got the NASDAQ there, the Dow there, the S&P here. So that was a pullback that occurred in all 3 markets at the same time. And so basically that's the kind of thing you want to see. Now you might get in a little bit late, right? You might get in, you might end up getting in here, or you might be able to get in at the top. So, you know, different markets are going to see you, or different swings are going to see you getting in at different times. But effectively, it's not a particularly difficult thing to look for. The key really with that is managing the trades and just making sure you're not the deer in the headlights. Okay. Right. So enough pullbacks. Let's go back to our egg with the stick on it. It's a bit of a longer egg today, and we're going to look at the range fade. I know this is one that Anthony looks at. So if you trade in index futures, the first sign of the markets reverting to range is that the correlations between the Dow and the NASDAQ tend to break down, right? You'll see volume on the S&P build at one or two prices, and then you're going to start crossing over that volume from above and below, and it just starts to build volume like that. It's amazing the way it works quite often. It's just like one price, you'll build like 1,500 contracts, and then it just cross over, up, down, over that. And by the time it's done that a couple of times, I'm thinking we're already in range mode. Okay, now if you start watching that, you'll realize that you can spot a range long before anybody who's just using charts can spot a range, just by watching that crisscross of the volume, right? So look for volume, exceptional volume at a narrow range of prices, and for us to cross over from above and below. Because with the range fade, you don't want to be fading the range on the 10th hit of the extreme, right? So the earlier you fade a range, the better. Those are your cleaner trades, right? Next thing we need to understand about ranges is they're not very precise. So sometimes you'll poke through the top of the range, sometimes you'll fall short. And the range size is obviously important, right? So if it's a 3-tick range, if you're in the summertime and you've got a 3-tick range, it's really hard to play. You know, if it's an 8-tick or a 10-tick or a 20-tick range, your potential reward is going to be worth the risk. So the key to range fade, spot the range early, ignore smaller ranges. And there's two types of range to play, and we've already talked about this. You've got the short-term range in a trend, because markets do tend to push and then range and then push and then range. And then you've got the longer-term range in a slow directional market, like the morning of FOMC. Now, with the first type of range, you are expecting a break on the side of the trend at some point. So it's worth considering only playing one side of the range, so you're not on the wrong side of the break. But for these longer term ranges, the kind of range we've got here, you can play both sides of the range. But I will say, I don't know many traders that can do it, right? Because traders tend to find it hard to reverse a position. They tend to find it difficult. I'm not sure why, but a lot of traders want to take a range trade, like say getting it here, and they want to exit at the opposite side and not reverse. They want to exit and be done, step back, look for the next trade. It doesn't make any logical sense, that to me, because if you're getting out at the top of the range, you think the range is done, so you might as well reverse. But I personally can't do it, right? So don't kind of worry if you take, you know, one extreme of the range, get at the other extreme of the range, and then step back, and then maybe next time you're selling the top, buying the bottom afterwards, and then stepping back again. So what is a range fade? Well, obviously you're going to buy what you consider to be the lower of the range, or sell what you consider to be the higher of the range this time round. So quite often you'll see one of the signs we've already discussed. It could be an iceberg order close to the extreme, could be we run out of traders, could be the correlated market start to move. And this is where it should become evident that those previous setups we discussed are made of building blocks, and we can use some of those building blocks elsewhere. Now, there is another building block we didn't discuss yet, and that's when the market starts to move back into the range with little warning. So you do sometimes just get to the end of the range and just pop back up, and that one is a little bit hard to spot, right? So a lot of times you'll get the iceberg, okay? And then if you get the iceberg in the extreme, that makes it a much easier trade. So the other thing you'll get, if the market does just pop, obviously, sometimes the market will move down and just start to pop up, you'll get the correlation trade. It gives you a later entry than an iceberg at the extreme of the range. And obviously with these range trades, because we're trying to focus on risk reward, if you see the range hold, sometimes even when you've got confirmation that the range is held, you've got to wonder, you've got to kind of ask yourself whether you really want to take it this time around, if there's actually enough room to the top of the range, or that's what I personally do. So anyway, back to our 4 questions. When does this work? Okay, it works when there's a pause in a trend, a short-term range develops, and it works when there's a general lack of news, lack of interest prior to FMC, while people are sitting back and waiting. Why does it work? Well, ranges, they work till they don't, right? But basically there's no commitment either way in the market. There's nothing going on that is push buying and selling outside of what's become a comfort zone, okay? So it's discomfort outside the zone. What confirmations are there? Well, icebergs, excessive volume at the extreme, fades at the extreme, correlated markets changing at the extreme, a pop up on a related market. What do we expect to see if it's not working? Well, if you buy the low here and we start to trade aggressively into and through the extreme, that's a good sign that your trade's failing. The other sign to look at is the highest traded price of that range. We all know the point of control, which is the highest traded price of the day. I look at the point of control for each of those individual ranges that form. So just find out where the most volume is in that range. If you buy the bottom of the range and you tick up to that price, what's got the most volume, and you can't get through it, to me, that's a red flag. And to me, that's when I want to get out. So that's my other failure point. What do you expect to see if this trade does work? Well, you're going to see a grind usually. You're not really seeing people stopping out. You will occasionally see some acceleration, but for me, when I'm looking at ranges, I usually see this acceleration when it goes to the bottom of the range and just suddenly launches back up without a lot of warning. The other thing you're going to see, even if it is working, it's going to tend to slow down in the middle, okay? Because the market likes trading where it traded before, and the most volume is generally going to be in the middle anyway. So as it gets to the middle where you trade a lot of volume, it's going to slow down. Doesn't mean it's failed. I tend to see it's failed when it hits that price and then starts to backtick on me. But even if it's working, it's going to be grind. It's going to be slow down. There's not going to be any pop. You can't expect the same kind of confirmations that you got with some of the other trades. Now, there's still components we can share between trades though. And then there's things that are different, like this kind of grindy move. So we can't always expect the same pop from every setup because every setup doesn't necessarily trade into stops. With these range trades, obviously holiday markets, we get a lot more range trades. For those of you that focus on a narrow range of markets, if you're only trading one or two markets, you are going to need to become an expert at this because you're going to have periods where the range trade is really the only one around. And the key to making those work for you is just be selective and not get into any individual trade if there's no risk reward skew. So for example, if you're falling short of the range and you've already started to tick up into the range, as you realize it's holding, risk reward is reduced, and you take that trade, you're going to need more of those particular setups to work than the setups where you get in at the bottom. Okay. And that's probably a more philosophical discussion that we could have later on. Right. Another trade around ranging conditions is the head fake. And again, I'm sure this is a specialty of Anthony as well. So you start off with exactly the same range bound conditions. The difference here though, on this setup is I wouldn't really take this if it's one of those short-term ranges that builds in a trend. So this one has to be a proper range bound market, and preferably after the extremes have already been tested a few times. So it's going to be a slow market, not a pause in a trend. And that's because it's a manipulation play. And manipulation tends to happen in slower conditions, like lunchtimes, dead days. So you start with the range, and then we move through the range. And usually this move is a violent move, and it will generally appear that the range is broken. So most likely some stops of the people short here are fired. And that's because somebody has actually purposely initiated the move up. Okay, now I know they've banned manipulation, but this still happens. And the only guys that I've heard have been caught for manipulating the market, been trading very, very small size, relatively speaking. But anyway, so somebody's basically nudged the market up. Okay, we get a bit of a violent move, and 5 or 6 ticks up, especially 5 or 6 ticks on the S&P. Market stops, and a massive amount of buying is observed by a big offer, usually by an iceberg on the offer side. And then this happens, right? So back to your 4 questions. When does it work? We covered that. Slow markets, lunchtimes, summertimes, any slowdown. Why it works? It's manipulation. The drive up from the range is initiated to bring in buyers. Some of them stops, some of them breakout traders. And then this buying is just absorbed by a big fish who's now holding a lot of contracts short because he's absorbed the buying by selling, and he pushes it down. So the breakout traders are now stuck in a bad position. What confirmation's on there? Well, this is actually a lot more interesting because a lot of the other ones you're looking for a limited confirmation. This is more like a game of chess. So this whole cycle is a progression of steps, from the initial breakout, then seeing the stop sit, and then finally seeing the absorption. If it's not working, basically you're going to get up past that absorption point. Okay. The second thing, sometimes it will get back to the range and it won't be able to trade into that range. So that's your second failure point. Now, if it is working, obviously what you're going to see first is this buying up here will dry out, and then the market will start to tick down. And normally it will go back into that range bound behavior and you'll start to move, and your target is the other side of that range. Now, if you've been in a trading range for a while, if you're like me, you feel a bit wary of hitting the extreme of a range like over and over again. So third hit to an extreme, fourth hit to an extreme of range, absolutely fine. After that, I don't feel comfortable trading a range. And by that I mean it's hit each side 3 times. I'm still okay to take the fourth after it's hit each time 3 times, right? After that, I'm not really very comfortable with it. So what I do is I wait for a head fake, and you see these all the time. So because of the extension as well through the range, it's actually a good trade because you've got more potential reward, right? So you've actually got that extra 5 or 6 ticks there as a bit more reward on this trade if you can target the other side of the range. Now, not only that, the entry point also very well defined, as is the exit point. So one of the things you want to look out for when this happens is also, if you see this up here, just look out for it. It might sound silly. You might get a similar size extension on the other side of the market, possibly another head fake below. In fact, there's times when you'll quite often get multiple head fakes on the same side of the market, over and over again. So you might get the head fake up 5 or 6 points. Next head fake up will be up here. Next head fake up will be up there. But again, same thing. After 2 or 3 head fakes, you're really pushing your luck in terms of taking them and expecting them to hold. So again, first head fake, second head fake, I'm quite happy to take those. Third head fake, I've just never had the spheres to take those. So as with all range trades, I always think the earlier ones are the safest. Okay, on to the last trade. And this one is almost the anti-setup, because what I want to do now is consider a completely different type of market, a runaway market. And if you talk to a lot of prop traders, most of them will tell you their results are not linear and they're in no way even across all days. There's a lot of average days, and then there's days where the opportunities to make profits are exceptional, which is where kind of the anti-setup comes in. Now, my advice to you is to look for this and sim trade it before you start jumping in. Again, a lot of people don't even realize this is here for some bizarre reason. Please don't get excited about the fact that exceptional opportunities exist on some days, because you don't want to suffer from exceptional losses. So anytime you get excited about a trade, it's usually not a good thing. So the anti-setup, it's not one where we're trying to pick a spot or finesse an entry. It's simply the ability to understand and recognize that external factors often send the market into overdrive, right? You might not see it for a month, and then you could see nothing but that for weeks. We saw a lot of this from October to December 2018. And these people, except perhaps Janet over there at the moment, most of these people were behind those moves in October to December. China trade war, Brexit, big drives of volatility and massive days. So you've got a choice on these days. You can join or you cannot join. What you can't do, though, is try and use the regular building blocks of your trades to try and construct your trades, right? So trying to fit your existing strategies to a market that has become highly volatile. So sometimes,
Peter, I don't mean to interrupt you. This was actually perfect as you're showing pictures of President Xi. It just came across the wire that some U.S. officials see China walking back trade offers. Some officials said to see China moves as normal, but it was negative. They're walking back some of these offers, and the market's sold off and continuing to create that momentum. There you go.
Yeah, and that's exactly the. Yeah, well, that's quite opportune, isn't it? That's exactly the kind of move we're talking about. So when you see that kind of action come in, you can't say, well, I'm going to look for my pullback setter. I'm going to look for my iceberg. I'm going to look for this, because it's just not going to work, right? So you can join or not join, but you're basically trying to fit your existing strategies to a market that's become highly volatile is very risky. So like we say, sometimes move something out of the blue, like that one did there. So thank you from China. And you just see the market start to rise or fall rapidly without any cause quite often. And it's not until you actually look at your news score afterwards that, you can see why. So it's always good to have some kind of news feed on hand to look at the moment things start to become very volatile, right? So you can see here, this is typically what you're going to see. So this was a morning when we had a lot of news, a big move in the Asian session, a lot of news about Asian shares and about oil. So what's the actual trade here? Obviously, the first thing to do is recognize it's none of the trades we've discussed so far, and it's not trading against the market. So there is a lot of volatility backwards and forwards. And so joining the move, it requires either a larger stop or successive attempts to enter with a smaller stop. What tends to be the normal trades I know is scaling into a larger position as the move progresses. So you kind of de-risk by starting small. Now, if you're a one-lot trader anyway, it's very difficult to de-risk by starting small. So when does this trade work? Well, big news causes panic, causes excitement, causes volatility. Why it works? Because markets are not efficient, right? So when a move like this starts, right, we don't just jump from one value to another value immediately, right? We don't just say, oh, market was 2,900, got some news, market is now 2,500, right? We see panic buying or selling. Now, what confirmations are there? Well, the confirmations are usually, unless it's like a scheduled news event like employment numbers and it's a big miss, usually the move's going to start and then you're going to see what the news is on your score, and that's going to confirm that we've got a news-driven move. What do we expect to see if it isn't working? Well, basically, you're going to get caught in the snapback. So like if you look at the S&P right now, we're in a snapback, right? It's you've got that big move down. Your best opportunity was probably here, but now it's snapback, right? So the kind of unlucky trade is to get short down here and then get caught on the snapback. Okay, some news just snap back straight away. Some news carries on for a long time. What we expect if it is working, the move continues. Now, with that extra potential reward, you do have a lot less confirmation with these trades, which is what you should expect, right? You can't have all that extra opportunity on the table and get in with a one-tick stop. But obviously, what we expect and how we actually behave, are obviously two different things. So event-driven momentum trades, they come with risk and opportunity. With any move out of nowhere, you have to keep an eye on the news just to confirm that that is a news-driven event. And you have to consider the news as well, right? Is it really going to make the market shift forever, or is it just a knee-jerk, right? So you have to kind of get a feeling for that over time. Okay, so quite often it's just a knee-jerk reaction to the numbers. So a great example of that is the FOMC, right? The FOMC comes out, everybody expects no change. Nobody trades in the morning. We get to afternoon, it is no change. There is no change, and the market goes wild. It's kind of like almost silly, really. It's just a knee-jerk reaction, right? The stuff from October to December was kind of more follow through, right? But anyway, you need to be aware of these things exist anyway. If you're not aware of these things existing, you try and trade the other 6 setups when this is going on, they're not going to work. So even if you don't trade this, you just have to realize that sometimes the market's going to go ape and become directional. Otherwise, you'll be trying to apply setups from your playbooks that simply don't work. Right. And
can I add one thing to that?
Absolutely, yeah.
You covered everything that I'd cover. I would say that if this isn't one of your sharpest tools in your toolbox, it needs to be. Unbelievable opportunity to understand news. But the only way you're going to understand direction after news is to anticipate it. At the beginning of this meeting, we'll call it, I always talk in the trading room is, what is the drivers? If you're sitting in front of your screens, and I said this when we started this particular webinar, and there's a black and white comment that says China's going to come and meet, they got a deal, or they're not. You got to know what to do, and you can't wait. The first thing that's going to tell you in a momentum news-driven trade is price. That's the first thing that's going to tell you if you're right or wrong. The key to trading news-driven events is you got to get it to go your way ASAP, because you're going to want to put on, you're going to double, triple click. You're going to want to have more size on. Someone did really well on this event just in this room, one of the more experienced edge guys, because you got to anticipate. You can't ask, well, what's going to happen when I hear this? It's a diligent reaction. You're driving a car. You don't have to think about what to do when the guy in front of you slams on his brakes. You scoot over because you checked your blind spot and nobody's next to you. You don't even have to hit your brakes. It's China trade. They're not going to get a deal and they price it in. It's bearish. Period. Done. Sell it. It should react your way. Also know where you're at on the map. What do I mean by that? Well, if the market already broke 7 points, you got it late. So now you really need it to go your way ASAP. So it's when you get it, what did the market do before you got it? And what the hell, and you should know this before the event came down the wire, is what has the market priced in for that particular geopolitical event? And the market's been pricing in bullishness because they think in April they'll have a meeting and there won't be a trade war and everything else. I don't know how long-term this weakness is, but the market's strong, anticipating a deal, more optimism than pessimism, and this changed it. If that's not a tool in your toolbox, it needs to become one. Once a year, I want people to catch an event like this. More, I want them to catch it every time it comes out, but at least get one a year where you can make your month in one trade. Because all the setups Peter talked about are awesome and they're good, but they're going to take more work than catching one of these guys. So this was an awesome webinar, though, Peter, and I didn't want to cut you off. Were you wrapping it up, or did you have more?
Yeah, just another couple of things. Yeah,
go ahead.
Right, and absolutely fantastic. And the other thing as well, once you look at this, right, just add, it's like you'll start to like if you're looking at the October to December, you'll start to get a feel for when the market's really skittish as well. You know, so you know at that point, you know, during that period, whenever something came out, the market went really skittish. Right now, as Anthony said earlier, market's bored of Brexit news now. You know, there's really not moving the market. So it's just situational awareness. But basically, we've actually gone over 7 setups already. So we know what makes a good setup. It's not about lines crossing over. It's about having good upside based off of the traders' activities, right? So, you know, we can see that a lot of the setups are actually comprised of different elements or building blocks we can reuse on other setups. Simple and powerful stuff. But there are still 2 things that will get into your way as a trader, right? First of all setups will stop working. No ifs, no buts, no setup works all the time. So forget the sales pitch of one setup for all markets, all time frames, all conditions. You know, you also have volatility peaked October to December, came back down in January. What I see in traders over and over again is that the moment something stops working, they look for something new. They keep no records of what works and when it worked. They move to a new setup and they forget the old stuff, right? Sounds familiar to many people. So when volatility shifts, then you need to adjust what you're doing or put it to one side and play something else. What you don't do is forget about it forever, right? Which is one of the things we do in Jigsaw. We've got this thing called a playbook, just really stupid, simple thing, lets you record your trades and when they work, right? So please don't forget that nothing works all the time. And just because something stops working, don't then presume that it doesn't work anymore, right? Because it's just a matter, there's just a cycle of volatility. It cycles up and down. And at first, you know, once you first kind of got your tentative clause interest set up and you start using it, you're going to be so excited about that and so focused on that you'll miss the fact the volatility is changing and the fact that, you know, you need to adjust it. So it's always about learn, trading, review, learn, trade, review, learn, trade, review. And with that, I'm done. And if we have any questions, I'd be happy to answer.
No, that was excellent. I actually paid attention. I generally will drift, but and that's just being people. That's what's hard about education is you got to be engaged to absorb, and the simplicity is where your edge is. And if it's not simple, then you're learning the wrong stuff. Meaning it's got to have an aha moment. It's going to be like, well, markets move down because longs are selling and closing their position. There's too many longs and they can't get it to go up and they're all going to the exit around the same time. That creates the selling. The move that we just had in the S&Ps was because we priced in a deal and now we might not have one. It could be a pending trade war. So it's like it's pushing. When I'm trading well, I'll put it to you this way. When I'm trading well, when I'm not trading well, I'll be able to still catch an event, if that makes sense. So when I know I'm still trading well, it's when I'm not trading well, but I'm not so beat up not to catch an event and be able to get back all the losses. And essentially you get bailed out. But but you get bailed out for skill that you have, not luck. You got bailed out for skill. Man, I remember in a prop firm, being down a lot, and then something came out as surprise, and it was click, 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 and I went from being down a lot. There was one time the risk manager, very few times did he ever come out and say, "Hey, you okay?" I could count it on one hand. So I was a pretty good risk manager when I was at the prop firm. But he came out, hey, he goes, Anthony, he said, you okay? How you doing? And I was down a lot, but more than normal. And I says, yeah, I just, I'm not seeing it today or whatever. And then boom, something came across the wire. And it was a revision to a number. Came out of nowhere. And it was like turn, click, click, click. I went from being down like 400 ticks, which is about 4,000, to being up 3,000 or 4,000. I got bailed out. And I got bailed out because I didn't beat myself up so much where I couldn't take advantage of opportunity. Now, questions that I could ask Peter. Let's see what we got. I did record it, Robert, so you're going to be able to see that on the recording. Go ahead, Peter.
Go on, sorry. Yeah, I know somebody earlier was asking, are there any charts? And there are absolutely no charts on purpose, because I just wanted you to think about who's getting it, who's getting into position, who's getting out of position, who's getting stopped out. And that's pretty much what you do, right, Anthony?
No, absolutely. And these guys that have done my course will draw a lot of similarities to the price doesn't move unless there's got to be an exodus. That's why when it's in a range, you've got open long and open short positions, but not enough of them yet to break it out. And you got to find that moment of when we're going to rally through the top of the range or break through the bottom of it. And if you get we'll call it getting chopped up, is you have an opinion when there just isn't enough imbalance of people ready to get out. And I always look at it as like a big banquet hall room where there's always people in there. And in the room, there are people who are long and there are people who are short. And they're all looking at each other, and that's the open positions. And they're all looking, and nobody's got the exit. And all of a sudden, one guy leaves the room, and another guy leaves the room, and all of a sudden, a lot of people are leaving the room. That's the market moving. Those are the people who are short that have to buy the position to get out. And so we're always watching. So your best bet is to know where the exit is and stand by it, and that's managing a good losing position because you manage your loss and you keep it small. But always think in terms of what other people are feeling. And one of the most resonating line I've ever said since I started helping people was, after you buy it, you're a seller. And after you sell it, you're a buyer. So after you sell it to get short, you now become a buyer to get the hell out. And that's what creates, if there's enough shorts, that creates the buying, if they're wrong and stuck and trapped, for an upside breakout. And then you could set it up with really cool, when I say cool, I mean the simplicity of your dome and the flow and the absorption and some of the answers people had in the chat when you asked them what they would look for, just that confirmation. So this was a great webinar that people have been exposed to. What else did I want to say? Oh, think about this for a second. And this just happened. That's why I'm going to share it with you over the weekend. When you're in a position or thinking about getting into a position, you're sometimes on the inside. You're not on the outside looking in because of the emotion. And you got to recognize that. And I'll draw a comparison. A friend of mine who is getting divorced, so he's back on the scene, right? He's talking with this girl that he knew and we knew and everything else, and they're texting, right? He shows me the text messages. It was over the weekend. And what do you think? And I looked at him and I thought, is he really stuck on the inside? I don't know how much confirmation he would have needed to just say, where are you at? I'm on my way. Yeah. That's all he had to say. It wasn't his fault. When you're on the inside looking in, you get lost. And in a trade, it's like, hey, you got the confirmation. What else do you need? By the time you see it, it's too late. She went back to Florida, right? And it's like, that happens to everyone. It happens to me. I'm sure it happens to Peter, where you're late, but at least you know you're late, At least you're like, well, I'm going to sell this thing because of the China news. That's gone. We might rally the rest of the day. Who knows? Another comment might come out to be bullish. So, yeah, you got to go with the flow. There's no doubt about it.
That's a great analogy, that is.
Well, I just had because St. Patrick's Day here
Yeah,
in the States. You guys celebrate that in Thailand or no?
absolutely. Let's celebrate anything. We've got 3 New Year's Eves.
So they had right. They had St. Patrick's because it was on a Sunday. I seen people dressing up in green on Friday. I said,
Yeah.
"Well, isn't it Sunday?" And they go, "Oh no, this year it's a weekend because it's on a Sunday and they're celebrating Friday and Saturday and Sunday."
Wow.
And so that analogy just honestly happened, and it just dawned on me. It's not necessarily his fault. I mean, at some point you should, yeah, it's his fault, but you got to understand why it happens. And when you're
Yeah.
in it, you're always looking for that additional confirmation because we all want one thing, certainty, you know?
Yeah.
And if we get certainty, that's fine. But you have to be like, you have to look at your decisions and your predictions as assumptions. And if they're accurate or probable, you go with them. And then you know when you're wrong. And it was the first thing I learned. I said this in the trading room today. Know where you're getting out before you get in.
Yeah.
That's how you manage your risk. But
And I think you have to boil it down as well. You have to boil it down to stuff you can actually do at the time, to not make it too complicated.
not simple. Like in a whiteboard I have, I'm not an expert in anything but simplicity. That's what I try to be an expert in. And say when someone says you're an expert trader, I says, no, expert traders in the real sense suck at trading because the experts have trouble admitting that they're wrong. Professional traders, we're good at admitting that we're wrong. That's what makes us pros. But it's the simplicity that you're trying to just be consistent with and at. And if you want to be an expert, go become a chemist or an engineer, where everything has to be exact or the building will fall down. You're looking for an exact moment to buy it. You're never going to get it. And you ever notice that if you adjust your size, you're like, I'm not that sure about this trade, so I'll put smaller size on. And it worked effortlessly, right? And then the one you're confident on, you got your full size on, it busts your stones and it beats you up and you end up taking a loser. Or if it was a winner, it took a long time. That was the one you were confident at. And just sometimes it's like, as long as you're consistent with what you're looking at, and it's not just some out of left field type of a trade where you're taking erroneous, stupid trades, you can't always just go where too confident. It's sometimes your mind playing tricks on you. But be consistent with simple. You can't be consistent unless you're simple. If it takes you 2 hours to go to the gym to work out for an hour, you're not gonna do it.
Yeah.
Too much prep work. Right? You run a lot, right? You're a runner?
Yeah, I hate running, but I do it anyway.
Yeah. The only time I run is when someone's chasing me.
I want to go running here. That quite often happens with all the rabid dogs.
Yeah, no, I bet that's crazy. I just got, and I got to give him a call back with the mentor tomorrow. The guy got me into this business, and the reason why I'm here today is because he got me into the business in 91 and back in the business in 96. And he's going in for surgery tomorrow, and I got to go with him because could be important, surgery. So you guys, I'm just saying this because he's calling me right now. So I'm going to end this up, give him a call back, and just always remember that there's people in this industry that genuinely have an interest in success in others, and then there's others that are just marketing and selling. And I'm not here to bash those guys. I'm really not. I'm here to underscore there are people that, and it's hard to do this. You got to be a genuine, certain kind of person, but genuine people that, hey, I take pride in having people build relationships with each other and just give them the very best chance to make it work. And that's what's important. So I'm glad you guys enjoyed it. A lot of people, you could see the chat, but a lot of people are thanking you, Peter, for an excellent presentation.
Well, it's always nice to hear. And thanks for having me, Anthony. And I will see you again soon.
Absolutely. Be careful. Stay away from the rat soup. And
stick to the duck beaks.
The duck beak. Go back to that duck beak because that's something I'd eat. I'd eat that. I'd try that.
It's good. It sounds bad, but it's good.
No, I would try that. The rat soup I wouldn't try unless I was starving.
Yeah, but you might not know at the start, right? It's just soup.
The soup. It might taste good. You're like, wow, this is good. What is it? It's rat. Oh, that's crazy. Well, if it's a well-fed diet rat, meaning in the field, maybe it's not as disgusting. Meat is meat at some point, right?
I think so.
But thanks again, Peter. Good luck, everyone. And this will be recorded for Edge Guys and not uploaded within a few hours. It's going to take a while to render because it's a long one. But thanks again, Peter, and we'll stay in touch.
All right, bye.